Today, folks, we're going to be diving into two real estate investment trusts. One of my favorite Canadian REITs being the Riocan, because they posted earnings today. And then I'm just going to highlight a US REIT that trades on the Canadian markets that's purely grocery store Encore that pays a massive 9% yield, and the kind of investors that might be appealed by these REITs. Because if we get into Riocan, first and foremost here, at its face value, it's not the most appealing stock, depending on what you're after in the market. Currently paying a 5.34% dividend yield. Year to date, definitely underperforming the broader market. It's down 4.25%. On the 5-year in the max chart, this thing hasn't done anything basically since the 2008 financial crisis. And from the dividend standpoint, many of us know they did cut the dividend. This has not had a long-term history of dividend growth, but recently they have been increasing it since they've come out of the pandemic. And probably the best buying opportunity was during the pandemic lows. Some of us did and were able to take advantage of that. So as I'm showing you these, you might be thinking this is a horrible REIT, but we're going to come around in a second and I'm going to explain to you why this is actually a pretty good value proposition, again, depending on what kind of investor you are. But we can see their current funds from operation payout ratio is just under 60%. The company has a lot of leeway in protecting the dividend they currently have, and they've also been doing share buybacks, which we'll see when we get further into the balance sheet side of it. When we take a look at the payout ratio against their peers, they're definitely one of the lowest, right? The peer average is 76% on a payout, and the distribution yield, it's literally lower than almost all the major REITs in Canada. And again, a lot of people might be turned off by that, but when we're talking about growth and stability in a long-term investment, that's a lot more stabilization than we're going to see. And Riocan's basically the largest retail REIT Canada has to offer. 191 properties spread across most of the entire country here, with the vast majority, 55% of the portfolio, just in Toronto. And their Toronto assets are world renowned. They are building some of the most premier properties. And what's very intriguing is the demographic, the profile, the people that live around their real estate. This is an important factor. Anytime you see people go out analyzing real estate, they want to look at the surrounding area. See, is it a high income, low income area? But the average is $135,000 for the household income, and it's a very dense populated area for their locations because that's what they focus on, right? And we can see this is a grocery Encore essential personal service. And in their earnings call, because I listened to it, the CEO very much fixated on the fact that there is no new malls, there is no new retail coming up in Toronto, the greater Toronto area.
Compared to the US, Canada has far fewer competing tenants per retail category. We also have approximately 40% less square footage of retail per capita than the US. A few factors will continue to temper the supply of retail space, including Canada's tight zoning regulations. In addition, the vast gulf between replacement costs and market values makes building new retail a very unlikely proposition. And then there's our commitment to immigration. Canada is the fastest growing country in the G7, and it's projected to welcome approximately 500,000 qualified, productive newcomers each year. These new Canadians naturally gravitate to transit-oriented major market locations to live and subsequently to shop. These are the same markets in which retail space is supply constrained. These factors converge to drive demand and create positive tension in lease negotiations for precisely the kind of well-located bricks and mortar spaces that Riocan offers.
So they have a high demand right now for people that are looking for retail space. So whereas most of the retail market globally is getting largely impacted along with office, Riocan is actually proving to be very stable in this current market environment. And again, we're talking about like Encore tenants from the likes of the liquor stores to the banks and some of the telecom giants. And I'm sure you've seen some of their outdoor shopping centers and malls. And talking about kind of the growth prospects into the future here, as mentioned, they're kind of fixated on building some of the most premier forward-looking condo buildings that are like condos in the top, like for residential. They got office in the middle and massive retail down below. I mean, these buildings are huge. They're building one of the largest condo developments ever in Toronto's history right on the main street. You look at some of these developments and they're massive, and most of them are already pre-sold and have major deposits that are helping stabilize the funding of this. I mean, take a look at across the board here, 99% pre-sold, and this one's not looking to be completed until the second half of 2024. Some of these aren't done until 2025, and they're pretty much fully pre-sold, which is very fascinating, right? Again, offering more stability for those of you that are looking for dividends. Now, let's talk about the net book value. For people that are looking for discounts, people that are looking for valued cash flow, This company's book value is $25.83 a share. It is trading below its book value, which is why we can see they've been buying shares back. That's another good thing about not paying such a huge yield. It's going to give you a bigger piece of the pie. So far, it looks like they've taken about 10 million shares off the books by the looks of it. And again, for the stock to be trading around $25.83, the current value is $20.26. And as I always recommend, this stock is a very good buying opportunity below $20 a share, because I'd prefer to get this closer to a 5.5, a 6% yield. So when the opportunity presents itself and we see these dips, if you're intrigued for somebody looking for stabilized cash flow, if you're somebody in a retirement phase of your life, these are the kind of investments I would personally be looking for, especially things that I prefer to hold in a tax advantaged account, because these aren't technically dividends, they're considered distributions, so they are taxed at basic income. There's no discounts on the dividends, so you're better holding it in a tax advantaged way. So I still love Riocan. I still think it's an incredible REIT, and it is proving resilient during a higher interest rate environment moment. But let's talk about some other ones here, because when it comes to kind of recession proof REITs, I do like the idea, and I haven't bought it. I'm not buying these right now. I'm just sharing the info because they're so intriguing. Is Slate Grocery REIT. This is a Canadian REIT, trades on the Canadian markets, but it is purely focused on U.S. grocery stores, and it has been a very stable REIT. I'm not sure what caused the wicked 50% decline during the pandemic. Would have been nice to take advantage of it there, but we can see that it tends to hover, between $12 and $13 a share, and it's a fairly small REIT. It's $612 million market cap. Taking a look, it pays a whopping 9% dividend yield, and like Riocan, very boring. We're not talking about increases. We're not talking about dividend aristocrats here. Again, if you're younger, if you're looking for growth, I would fixate more on broad-based ETFs, perhaps like SCHD, or even buying individual companies like Pepsi or McDonald's, or companies like that when they come on sale, or Canadian companies like TELUS, or your banking sector, or things like that when they're more discounted. You get better dividend growth. But again, we're talking about cash flow today, and I think it's always prudent for people that want cash flow today. They're going to be buying some of these in their portfolio, and this company is very intriguing because it is encored by like 5 major tenants, being Kroger, Walmart, very resilient. I mean, that's 70% of the portfolio basically is just within these necessity-based, well, they're all necessity-based products, right? They even have medical and personal service, dollar stores, financial institution, pharmaceuticals, liquor stores. So this is another really intriguing retail REIT. And again, it's primarily fixated in the US, something you're going to want to hold primarily within a tax advantaged account. But what I want to show you here is this company can't afford this dividend. Currently on their Q1 financials, their funds from operation, or their adjusted funds from operation, was around 22 cents. The declared distribution per unit was about 21.60. And if we just take a look at the FFO payout ratio, again, from the funds from operation or the adjusted funds from operation, it's between 82%, but again, from adjusted, it's about 98. They tend to trade right toward the balancing of basically paying out the vast majority of their income, and it's been very stabilized. It's been growing. I mean, the gross book value has been increasing nicely. It is trading at a little bit of a discounted multiple here, I do believe, but it's just kind of one of these really intriguing, boring, non-kind of growth REITs, but it's paying a wicked yield of income. And again, I would be more intrigued to buying something like this than over a lot of the investments we hear about when it comes to perhaps option ETFs. And I find the comparables when people are looking for super high yields that are over 10% coming from these option ETFs, the option ETFs have actually proven typically to be a little bit more unsustainable over the long periods of time. And a lot of these option ETFs most people look at have not been around for that long. And again, find me one that has a long-term track record of outperforming the general markets, because of the deterioration of the stock price that never ceases the upside when the market goes up. You just continue to get the deterioration. It just always seems like the dividend is cut dramatically in half compared to what you're actually receiving. Because I find with stable businesses like REITs, and you can diversify with some growth REITs, things like Stag Industrial, Canadian Apartment Properties, O Realty Income. If you pair it with some of these higher yielding REITs that have proven to be a little more recession proof, you diversify that, you'll be getting a much more sustainable yield for somebody that I think, if you're in a retirement phase, would be more prudent to looking at. But I'll pass that question off to you. I'd love to know what you think in that comment section below.